Good morning, everyone. Barry Knapp with Ironsides Macroeconomics. It's 8:30 a.m. on Monday morning, November 10th. Our note this week was titled Cyclical Bond Bull, Secular Bear. I've spent the last 90 minutes or so on the phone, on conference calls, discussing the trajectory of growth and policy, in particular over the next couple of months. And it was all consistent with what I'd written this weekend, which is an idea that probably have one final leg to the cyclical bond rally, 2025 cyclical bond rally. I would expect after the government's reopened and we get the data dump. This is not something we wrote about, but the inflation hurdles, if you will, for the annualized rate, or comps for the annualized rate, that is, will put downward pressure on CPI over the next few months, such that the narrative, how can the Fed be cutting with a 3% inflation rate, will start to dissipate a little bit. I'm not arguing it's going to 2 or anywhere near target. We've never argued that. But really the catalyst for a further rally in the labor market will be or further rally in the bond market will be the labor market data, which ensures we get a December cut and probably a January cut as well. But at that point, there's a pretty high probability we move back into the secular bond bear market. So let me work through the note here. We began with a section on, in essence, we have a cold plunge before the government starts to run it hot. Then we created laid out our case for one more leg in the Treasury market 2025 rally. We then went on to discuss the Supreme Court oral arguments around the IEPA trial last week. We titled that section the non-delegation doctrine. Went on to talk a little bit about fixed income supply and update you there in light of the Open AI CFO hinting they may need some government support for their financing. We then moved on to talk about QT ending, but DT, that's duration tightening, beginning. This is a really important point. I think y'all should understand it as to the way we've laid it out, but we wanted to just clarify the point again, and I'll speak about that in a minute. And then our final thoughts wrapped up with our idea that the shutdown was just about to end, and sure enough, about a day after it was published, the shutdown is just about to end. So going back to the beginning here, we do think when all is said and done, we get done with revisions to GDP data and all, we're going to find out that PDFP, that's private domestic final purchases, have been running less than 2% throughout this entire year. And that's a function of the 3 policy shocks that the Trump administration hit the economy with, which is in essence the detox from our addiction to government spending, and we would add cheap Chinese imports. So it's trade policy, it's reduced slowdown in government spending, and it's the reversal of the population surge, immigration policy, have all slowed growth decidedly this year. It's exacerbated the K-shaped economy, which our lens on that is less the consumer and more the business sector, which could be tied to Fed policy. Fed eased through their balance sheet, tightened through rate policy, put the burden of tighter policy on the small business sector. Ongoing theme, I won't belabor. And you could see that in corporate earnings. Equal weighted earnings, we had a chart in the note on this, are running decidedly below cap weighted earnings, something that typically only happens in recession. And it's indicative of just how unbalanced the economy is as a result of going through all these policy changes. And at its core, it's monetary policy that really started this and continues to put pressure on the small business sector. So we still think the run it hot scenario, a reacceleration of growth in 2026, is a reasonable base case. But if that part of the story is starting to stall out, we get this weak labor market data, and it doesn't start to rebound early in 2026, we thought additional stimulus is likely. Well, sure enough, we get the proposal floated on Truth Social this weekend about sending $2,000 rebate checks. Now, remember, there was an extra reconciliation bill last year. There'll be another one available to the Republicans next year. That's how we got to one big, beautiful bill instead of two bills, as Senate Majority Leader Thune first proposed. So if the Republicans get nervous about the midterms, and after last Tuesday's elections, they may very well do that. And we have a chart in there on the UMich sentiment numbers by political party, including independents. Stimulus is entirely possible. So that for us would get us to the run it hot scenario, but that's how we get a real reacceleration of inflation in the non-housing services sector. And you allow goods prices to start getting pushed through or passed through. So that to us would be really risky policy, and risky is putting a nice shine on it. That just would be bad policy. That's how we get back to our inflation is always and everywhere a fiscal and monetary phenomenon, and we get fiscally driven inflation. So we'll leave it at that for that part of it. But between now and then, we went through our labor market statistics and justification for thinking we could get a rally in 10s to 3 3/4 before we get to that run it hot scenario sometime in the first quarter next year. And just going through the labor market data, the ISM manufacturing and services sectors are both in contraction. Fed surveys show, in particular, the service sector employment component in contraction. The Beige Book suggests the labor market is contracting. The labor differential implies the unemployment rate is 4.5% or so. The ADP small business component has been -5 of the last 6 months, 5 of 7 months since Liberation Day. Bank credit is still quite weak for small businesses. All of that, with some further cuts, will get us to a steeper curve and demand for the back end, which could get us to the run at hot scenario. But between now and then, the Fed really does need to cut rates. And we thought Mary Daly on Bloomberg this morning absolutely nailed it. She made a point that we've been making, which is when you look, you're trying to debate whether this is the slowdown in employment growth is driven by supply or demand. If it were being driven by supply, you would see wage pressures in the sectors where less skilled workers are, prevalent, abundant, and you're not seeing that. When you look at that, of course, we only have the data through August, but when you look at the Atlanta Fed wage tracker data, that lowest income quartile wages are under pressure. The paid hourly wages are under pressure. So this is really more about demand than it is about supply. And that's our justification for thinking we get the labor market data, we have one more push in the treasury market, and then you can reset shorts. That's how we get from our cyclical bond bull to our secular bear. So now moving on to the Supreme Court oral arguments around the IEEPA tariffs. We had some, we thought, pretty interesting quotes. There's the ratchet effect that Gorsuch talked about, the non-delegation doctrine. But then there's the mixing of foreign affairs, where Kavanaugh and Roberts hinted that they may come to some sort of solution, which means the use of IEEPA is not lawful, but they give the administration an out to keep the tariffs in place. We then went on to discuss how we think that the effective tariff rate, and we backed into some numbers for imports in September, we obviously don't have that data, is effectively at 12%. We've had customs duties, tariff revenues peaking just below $30 billion for the last few months. That seems to be the level. So the macroeconomic effect in terms of tariffs, we're not talking about the inflation effect here now. We're talking about the amount of revenue that the government's collecting and the impact on imports has largely worked its way through the economy. So there's still an uncertainty effect, and there's a risk that the pass-through would pick up if there were stimulus that put more dollars in the consumer's pocket and allowed them to absorb the pass-through of tariffs to final prices. Right now, that pass-through doesn't exist, as evidenced by margins in the staples sector, but that could change if the Republicans get nervous about the midterms and crank up the stimulus printing press, so to speak. We then went on to discuss fixed income supply, and all the controversy about OpenAI CFO talking about potentially needing government guarantees. And listen, Morgan Stanley put out a report back in July that if you all haven't seen and you have access to, it would be worth reading, where they estimated $3 trillion in financing capital investment between now and 2030, 1.4 trillion of which will come from hyperscaler cash flows. The other 1.6 is going to need to be financed out of the debt markets, and that may very well include sovereign financing. So if you're Japan and you've made a pledge to President Trump to invest in the U.S., be a pretty good place to invest in as much as you could sell equipment to data centers and then help finance the build out of data centers and power infrastructure and the like. And so there is going to be some sovereign involvement, whether it goes to OpenAI or some of the competing prizes. Is a whole different story. And of course, CoreWeave's earnings tonight will be interesting because they are one of the companies that is starting to aggressively use debt financing to build out this data center infrastructure. So anyway, we do think this is going to be a much bigger story in the first half of next year, where the supply of debt starts to overwhelm this seemingly insatiable demand for this stuff at this point. So final point, and I'll kind of wrap this up, which is, QT ended, and there's a lot of people talking, New York Fed President Williams was talking about potentially having to start QE again next year to expand the balance sheet to provide more reserves in the system. We didn't talk about the regulatory component of this. We just really strongly wanted to make the point that there are three channels for QE. There is the liquidity channel, increasing bank reserves, but then there's the duration channel and the volatility channel. The duration channel is far more impactful on the capital markets, broadly speaking, than is the liquidity channel. There's such focus now on this liquidity channel, but because of the way they've done QT only really affects liquidity. It has no impact on duration or volatility because they decided not to sell securities outright. They're just waiting for them to mature and run off. So they made a decision at the last meeting, and we made this point, and we can't emphasize it strongly enough, to start reinvesting mortgage paydowns into bills rather than into notes. That is duration tightening. It's not a big number. It's 17, 18 billion per month. It may pick up next year if we do get this rally in treasuries, steepening of the curve, demand for CMOs and other mortgage-backed securities picking up by the banking system. That supply of fixed income could pick up as well. But this is real duration tightening, and that is more important for the markets than the liquidity ample reserve regime, which, by the way, we think is going to get changed next year through regulatory policy loosening anyway. So that's it. 2 weeks ago, we made the decision not to cut risk because we did think the shutdown would end. The shutdown is ending. We're going to get the labor market data that's going to put the Fed back on track. It likely brings the seasonal rally back into play. But, spoiler alert, our outlook for next year is likely going to be looking for a decent sized correction sometime in the end of the first quarter, beginning of first half at least of 2026, because things are going to change dramatically from a whole bunch of different fronts, including the inflation outlook and this whole run it hot scenario. So that's it for me this week. Barry Knapp from Ironsides. I'll be finishing the note up from Florida. We're going to take a little break and get some sunshine while it starts snowing out here. Have a good week, everyone. Thanks.